Hello, in this lecture we're going to compare a flexible budget to actual results. So what we're going to do is we're going to take our fixed budget over here, we're going to convert it to a flexible budget based on the actual results. So notice that the standard budget is based on 18,000 units. What actually happened is 21,000 units were produced. So we'll take a look at the difference if we were just going to take the difference between these two numbers and see if we just had the fixed budget, what would happen and how it can be somewhat distorted, our results being somewhat distorted. Then we'll convert our budget to a flexible format in terms of breaking it out not by category over here, but instead by variable versus fixed costs, and that will allow us to then make it flexible, seeing what we should think or what we would think would happen based on a unit production level of 21,000, which will give us some information that might be a lot more helpful when trying to figure out what we're doing well and what we're not doing well. So let's see how this would work. So first of all, we have the budget over here was based on 18,000 units. We actually made 21,000. If we were just to compare what we budgeted to happen compared to what actually did happen, I'm going to say this is going to equal, and I'll take the actual, so I'm going to take this number minus this number, and so there we have it. So sales, of course, is higher by 753,000. Now, that would be expected if, of course, we sold more units, then the sales would be increased. If we took the direct materials, we're going to say this number minus this number means that the direct materials would mean that we used more in direct materials. Now, if we didn't take into consideration the fact that we made more units, we might be saying, oh, we're over budget on direct materials. And of course, if we actually kind of penalize someone, like, someone in the manufacturing department saying, hey, you're over budget on direct materials, that would be unfair. Well, it'd probably be unwise for us to do, considering the fact that we produce more units. That's the problem here. We can't really say whether the production department did a good job with materials or not, because of course it's going to be the fact that they have more expense on the materials. We produce more than we thought we were going to produce. So we need to find a better number to measure that. That's the point. Same, of course, with all the variable costs. So direct labor is over. If we took the machinery, it's going to be over than what we thought. Hey, everything's over budget. What happened here? We did a terrible job. No, we didn't do a terrible job. Or not necessarily. We don't really know. But we would expect all the variable type things to be over budget. Now, these fixed type things, in terms of depreciation, stayed the same. Well, of course it's going to stay the same. It's a total estimated number. That one's not going to be over or under. It doesn't change with the level of production. Utilities has a variable portion. The plant management salaries should be fixed. So notice that one's different, even though it is a fixed salary. So that's a little bit unusual. We've got the 2,000,004 in the total cost minus this one. Whoop. And so there is that. So then we have the gross profit is going to be the 2,314 minus the 1,833,000. And then if we go to the selling expenses, we're going to say the packaging is going to basically be variable, I believe. So of course that one's over. Of course it is. And then we're going to take the shipping, and of course that one's over. And then we're going to take the sales salary, which is fixed, and that one should be somewhat the same. It's a bit different. And so we're going to say, okay, those are those. And then we'll do the same thing for the general administrative. These are all fixed, I believe, so we would expect them not to change much with the level of production. So there we have these items there. And then we're going to take the total general administrative, and we could calculate this one out like so. And so there we have our end numbers there. Okay, so there we have that. Now we're going to make it flexible because, like I said, a lot of these, if we're trying to measure and see how we did in these types of areas, these numbers here not too helpful, not too helpful. Now, if we were to make those numbers what we expected to happen based on what actually happened in terms of production, then we could say, okay, direct material folks in the manufacturing department, you did a good or bad job, based on something that is reasonable. So in order to do this, we're going to do a similar thing that we did in the prior problem, where we're going to break it out by per unit for variable costs. We're going to break out the cost between variable costs and fixed costs. So let's do that first. So we're going to say sales is going to be kind of like a variable thing, right? We're going to say it's going to be the 253,000, and it's going to be divided by the number of units, in this case being the 18. That's what, whoop, I took the wrong number. scratch that. We're taking the original budget of the 4,050,000 sales divided by the 18, and that means we're having the 225 sales per unit. Then we got the variable costs, colon, and the variable costs are going to include the direct materials. I'm going to do this a bit faster here because we've seen this before. It's going to be the direct materials, and that's going to equal this number divided by the 18,000 units. That's the per unit total. And we have the direct labor, so that's going to be this one, tab. I'm going to say this equals this number divided by this number, and enter. And then we got the machinery repairs. That's going to be this one here. Also variable because it says variable right there. So we're going to assume that's variable even though it might not be as clear. And then we're going to take the 90,000 divided by the number of units. And we have 5 per unit. And then the utilities, that's that funny one that's mixed. And it has a 72,000 variable portion of the 232,000 total. So we're going to say this equals the 72,000 divided by this 18,000. That's 4 per unit. Then we have to pack. So then, so that means the plant management fees not variable. I'm going to make it yellow. And then we're going to skip down here to the selling and expenses because these are subtotals, obviously. So the selling expenses, we got the packaging. That one is going to be variable. So I'm going to say packaging. This is my next variable one. Notice we're grouping them not by category, but by behavior of costs here. So it's this divided by that. And then we've got, what's next? Shipping. Shipping, we're going to say is variable as well. So I'm going to say shipping changes with the level of production, making it variable. This divided by the 18 there. And then I think that's going to be it for the variable. So then we have the sales salary, that's fixed. We have the subtotals, and then we have all these advertising fixed, salaries fixed, and entertainment fixed. So I'm going to say those are fixed. And then we can have the total variable costs here. So I'm going to go ahead and indent these. I'm going to highlight these, home tab, alignment, indent. And then I'm going to copy this for the total down here. I'm going to paste it right there. I'm doing this a little fast, sorry for that. And this is going to be total and variable. And I'm going to get rid of the colon over here. Go back on it. I'm going to go to the home tab. We're going to indent it 2 times. And then I'm going to sum this up. So I'm going to put an underline on the 8. I'm going to go to the home tab. I'm going to go to the font, underline it. And then we're going to sum up here. We're going to equals the sum of all the variable cost per unit stuff, which is the 60 down to the 8. And there we have that. I'm going to go ahead and underline this one. I'm going to go to home tab, font, underline. And then we're going to have the contribution margin. And remember, that's the one we don't really see on the normal income statement, but we see it here when we break out the variable cost to fixed cost. Very important for this type of statement because it's going to be the sales minus the variable portion. And then we're going to break out the fixed portion, of course, fixed costs. And I'm going to put that in the fixed cost column over here. So I'll put a colon by that. And that should be all the yellow ones, the ones that we made yellow. And I'm going to make this one, that one should have been made yellow too. That's going to be yellow as well. So we're going to say, okay, fixed costs then are going to be the yellow folks. So that's going to be this one. And that's going to be the 315. And then we've got the plant management salaries. And that's going to be the 230. And then we got this other yellow guy down here, which is the sales salary. And that's going to be the 260. I'm going to scroll down a bit so we can see everything. Seeing stuff is good. And then I'm going to go down here to the advertising. And that's going to be the 134. And then we're going to go to the other yellow guy, which is here. We're almost done with the yellow folks here. And that's going to be the 251. And then we're going to go to the last yellow folk guy down here, the entertainment or gal. And that's going to be the 90,000. All right, so then I'm going to put an underline under the 90,000. I'm going to go to the home tab. I'm going to go to the font underline. And that's going to give us the total. So I'm going to indent these. I'm going to highlight these. I'm going to go to the home tab. I'm going to go to the alignment, indent 1 time. And then we're going to total these up. So I'm going to copy this. It's going to be total fixed cost. I'm going to copy fixed cost so I don't have to type as much. And then I'm going to put in front of it total. And then make it a lowercase there. And I'm going to, oh, not a G. Where does the G come? And then I'm going to get rid of the colon. Enter. Then I want to be on the cell, not in the cell. And indent it 2 times. 2 times. Okay, so then we have that. Then I'm going to sum this up on this side. So we're going to sum this up, all the fixed costs, summing these up. These are the things that don't change with the level of production. And there we have that. And you might be saying now that I did miss one now, right now that there's something missing in here. And note that if we don't do a check figure, we wouldn't see that something is missing. So I'm going to do the check figure and see if we can get to this number down here. We won't. And then I'm going to go back and try to fix it and see what we're missing down here. So that's why we do the check calculation down here. So we're going to do a check calculation and try to tie it out to this number. So what we've done is we've done it per unit over here. And if I multiply that times the number of units, 18,000 units, that would give me the, the contribution margin. And so the reason we can't do that for the fixed costs is because they don't act the same. But if we only have the 15,000 units, then I could basically just take this number and divide it by the 18,000 units and allocate it to those units and then figure out, basically tie it out to this number. So let's do that calculation just to show what that could look like. Sales volume in units. We said in this case was for the fixed budget was 18,000. And then if we took the fixed costs allocated, so then we're going to take this fixed cost and we're just going to allocate to those 18,000. And now you'll recall last time that we left off with the contribution margin, which is the sales minus the variable cost per unit. Now we got the fixed cost per unit. So if we're basically going to come up with the income from operations per unit. So I'm going to copy that. I'm going to paste it here. Income. Oh, whoa, I didn't like that. Paste. Income from operations per unit. And that's going to equal the contribution margin that's 127 minus the 71. So this is kind of where we would be at per unit if everything was variable. So now if we just multiply this times the sales volume, which is this 18, we should then come to the income from operations, which is going to be the 56 times the 18. This number, if we did everything correct, should then tie out to this number. It does not. Why doesn't it? Well, there's something missing here, and what's missing is that this one was mixed. Remember, that's a mixed cost, and I didn't include the mixed cost over here. So what I'm going to do is I'm going to say that's going to be under here. So I'm going to highlight these. I'm going to pull this down. I'm going to pull this down, and let's see if it lets. Then I'm going to highlight this. I'm going to go to the paintbrush.